Welcome back to Spread the Wealth. I'm Jarrett. Like and subscribe to help my channel. Okay, so there's some very cool things happening January 1st, 2022 for precious metals. And so the question is, will gold and silver explode in price in January? And the answer is, they might. So let's dive in. After the great financial crisis of 2008, also known as the GFC, the world got together and decided that we needed to change banking rules and regulations a little bit to prevent another collapse or near collapse from happening like pretty much happened in 2008. So a lot of the banks got together and started a thing called the Basel Committee for International Banking to decide a bunch of rules to make everything more stable. Most of the rules have to do with capital requirements and funding ratios, but the rule that we want to talk about today that has to do with precious metals is what they call the NSFR, or Net Stable Funding Ratio. So to understand that, we have to dive in a little bit how the futures market works. So most traders are trading to make money. They sit at home, they make contracts, they wait the amount of time, the duration of the contract, and their goal is to make money on the contracts. They don't necessarily want to take delivery of the item they're making a trade on. For example, recently last year, there was a big kind of blow up of the oil trading market, and people got stuck taking delivery of oil that they don't want to take delivery of. So we're sitting at home trading contracts on the computer, and maybe one of the contracts is that you're placing an order for 1 million barrels of oil. And if you win the contract, generally the person offering to sell 1 million barrels of oil will cash settle, meaning they pay you the difference in the contracts and you make your money, they lose the money, you move on to the next trade. But they got stuck having to deliver the oil to people sitting at home on their computers who don't have somewhere to store 1 million barrels of oil. And so what happened was they had to find someone else at a lower price and a lower price and a lower price that could take delivery of the oil. So what happened in the end was that they had to pay negative $37 per barrel of oil because nobody had somewhere to store it and they were stuck taking delivery. So oil went to the price of negative $37 a barrel. They would pay you $37 for every barrel of oil that you could take delivery on, which is unbelievable. And it happened because people are trading contracts and don't have the ability to take delivery of these contracts. So as of right now, the vast majority of traders that are trading futures contracts don't take delivery of the commodity that they're trading. So we'll say gold and silver. So if someone wants to make a contract to say, I'm going to buy gold and silver, and if someone wants to make a contract saying they're going to sell gold and silver, they don't actually have to have the gold and silver. And the institutions that back these trades, like the LBMA, which is the London Bullion Market Association, or the CME, which is the Chicago Mercantile Exchange, they don't actually have to have all the gold and silver either, because they know the vast majority of traders don't take delivery. So what can happen is, say there's 1,000 traders trading contracts for, we'll just say 1 ounce of silver to make this easy. The LBMA doesn't have to have 1,000 ounces of silver because they know the traders won't take delivery of the item and actually receive the item. At the end of the trade, one person will pay the other person cash and they'll move on to the next trade. But spot price is determined by these trades. It's determined by people who don't have silver or gold and don't want silver or gold and can't deliver silver or gold, but they get to determine the price that we pay if we walk into a bullion store or a coin shop and say, I want to buy silver or gold. So it's a false supply and demand dynamic created by people trading futures contracts on paper. But what Basel III does with the NSFR is that it says that the LBMA and the CME have to have 85% physical coins or bullion to back each trade. So out of 100 trades, 85 of them have to be backed by physical, which means that they can't just make up an unlimited amount of these paper contracts. They have to have the silver, which means that they have to go buy the silver to have it. So it creates a supply and demand dynamic that could actually show the world how much gold and silver there really is for sale. Because nobody really knows. They can do calculations and have estimates based on jewelry and all these other things, but they don't actually know how much gold and silver is for sale. So how do you know how much you're willing to pay if you don't know how much there is? If you want the very last ounce of gold, you're probably willing to outbid someone else who also wants the very last ounce of gold. And so you bid back and forth and the price goes up, 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 up. But if you don't know what's the last ounce of gold, maybe you won't even take delivery of it. Maybe you won't offer a real market price for this thing. Because who knows how much there is? It seems kind of like there's a lot. We don't know. So to go back to our original question, which was, are the prices of gold and silver going to explode in January? I kind of see three possible answers to this. The first answer is that Basel III goes into effect January 1st. People see how little gold or silver is actually for sale in the market, and they all get scared that they're not going to get any, and they all pile into the market, and the price explodes. I don't really think that's going to be the answer. Another answer is that Basel III doesn't go into effect on January 1st. So it was supposed to go into effect in 2015, I think, and then it was pushed out to 2018. Europe was supposed to do it in June of this year, and they said, nah, we're not really going to do that right now. But America is kind of the leader in finance in the world, and they're supposed to be the responsible party. So with them supposedly scheduled to do it January 1st, I think it's kind of likely that they do. But for the second answer, let's pretend that they don't. So it could be like a buy the rumor, sell the news type event. The rumor is that Basel III is going to take effect and it's likely to push the price of these metals up higher. And so knowing that, people start buying silver in advance, hoping to have the silver or gold in hand, so when the price goes up, they can profit from that. But if it doesn't go into effect, they realize that this investment isn't going to profit them what they wanted, and so they may sell their silver into the market, which would actually lower the price. Sell the news. So the third option takes a little bit more information from the futures market. Only the new contracts have to follow the NSFR 85% requirement. And so contracts that were made 3 months before don't have to follow that, or 2 months before, or 1 month before. But the new contracts that are established moving forward do have to follow that. So let's say there was a contract made in October that expires January 1st. There's one made in November that expires February 1st. There's one made in December that expires March 1st. And I actually think that they expire the third Friday of the month, but let's just use this for the sake of this video. So January 1st, you have 2/3 of the market that don't have to follow the NSFR requirement, because only the first new contract has to follow it. By the end of January, one of the ones that aren't following expires and a new contract is created that does have to follow. So 2/3 of the market have to follow the 85% requirement. Now, are one of those thirds enough to show that they're out of gold and silver, that they don't actually have any more for sale? Or is two of those thirds enough for the market in the world to realize they don't really have any more for sale? Or are we going to get 3 months into this and then see how little silver is actually for sale? And maybe they don't have enough to fulfill all the contracts. Because remember, right now, they can make as many contracts as they want just out of paper without backing it with anything. But if people start taking delivery, or they can, NSFR, have to back them all by 85%, seems like one of those 3 months of expiries will be enough to show that they don't have as much silver as all the contracts they currently have outstanding. So it seems to me it may be a combination of people piling into the market, the buy the rumor, sell the news, and a 3-month delayed expiry. So the price has been creeping up recently, maybe because people know Basel III is happening. Then it happens, but the very first month, the very first day probably isn't enough to show that they don't have all the silver to fulfill the contracts. So I don't think the price is going to do very much on January 1st. But some people that bought silver might not understand all this and decide, this investment's not getting me where I need to be, so I'm going to sell my silver. So the price could start dumping a little bit. But it seems likely that sometime over the next 3 months, if the number of contracts that are currently being created continue, there's going to be a point where they don't have the silver to back all of these contracts, and they won't be able to make contracts because they don't have the silver or gold to back them. So, is it possible that the price explodes in January? Yes, it's absolutely possible. It seems likely to me that it might take a couple of few months for the expiration of some of the contracts and the creating of new contracts to show how little metal there actually is. So if you look back in history, how high can the price get? In 1980, the silver price got to about $50 an ounce, and again in 2011. But that's the nominal price. It's the actual US dollars that they received for an ounce of silver at both those times. So what about the real price? What about adjusted for inflation? So the 1980 $50 is equivalent, if you believe the inflation rate of the government, the CPI, it would be equivalent today to about $167, somewhere around there. So the $50 that you had back then was worth about $167 in today's money. 2011, I don't know the math exactly, but we know it's more than $50. So the nominal high historically has been $50. The real high historically is somewhere up around $170. So could it get past $200, $300, $400? It could, absolutely could. I don't know what it's going to do. Gold tapped out just above $2,000 this last year, and also back in 2011. But in the 70s, it started at $35 an ounce on August 15th, 1971, when Nixon took us off the gold standard, and rose up 24-fold in the next 9 years because of worries about currency problems and inflation. They called it stagflation in the 70s. And it rose all the way up by 1980. It was $850 an ounce from $35 an ounce in 1971. So when prices move with metals, they can move dramatically. But in the last 10 years, I think there's been a retrace in the price of gold even. So he didn't make anything in the last 10 years. But that sure seems like a reflection of the old way they make contracts and determine spot price, and not the value of gold itself. So with the NSFR requirement, 85% backing, it sure seems like the price should be going up if they take it into effect. And we'll see that later. So like and subscribe. I'd like to continue learning finance from everybody all the time. So comment below to teach me something.